I'm Morris Lyles, your 2021 South Carolina Realtors President, and I'd like to thank you for joining us today for this important program. We've got a lot of information for you today, so while you're watching, please feel free to type your questions into the Q&A box on Zoom or leave a comment if you're watching this on Facebook Live. Toward the end of the program, our friendly panelists of NAR and FEMA staff will address your questions. I'd like to give a quick thank you to Austin Perez with NAR and Andy Neal, Tony Hake, and Kelly Williams with FEMA for helping us coordinate this program for you today. I'd also like to welcome the realtors from across the country who are joining us on Facebook Live. We're glad to have you here with us this morning. As those of you who were around in 2015 know, in South Carolina, flooding is an increasing concern for realtors and the clients we serve. Those historic floods in South Carolina caused $12 billion in damage to our state, displaced families, and some even lost their lives. In the aftermath, NAR and SCR were there to help with assistance to South Carolina's flood victims through the Realtors Relief Foundation. The amount of money raised through donations by realtors, organizations, and individuals, state and nationwide, came to almost $500,000. SCR's small staff received, reviewed, and processed more than 700 applications over 4 months and issued 419 grants, totaling $323,238. The floods of 2015 were a wake-up call for many South Carolina homeowners about the importance of flood insurance, and realtors are now more than ever expected to be knowledgeable about flood coverage for their clients. When we found out FEMA would be updating its risk rating methodology to risk rating 2.0, and it could increase or decrease the cost of flood insurance for our clients and customers, we asked NAR for an update. Austin Perez, who's Senior Policy Representative of Insurance Issues for NAR, went above and beyond and helped us schedule FEMA Senior Executive David Maurstad to speak with us today. Now I'll hand it over to Donna Smith, SCR past president and realtor with Berkshire Hathaway C-Dan Joyner, and former chair of NAR's Member Insurance Committee, to introduce Mr. David Maurstad. Donna?
Thank you, Morris. Thank you so much. And first, I'd like to thank all of you so much for helping us with this issue and offering to do the webinar for our members. As Morris mentioned, this is a topic I've been very passionate about for a long time. I'm so excited to introduce David Maurstad to you. David is highly regarded for his transformative leadership in communicating disaster risk, closing the insurance gap, and incentivizing mitigation action against varied national hazards, with a primary goal of reducing disaster suffering for all communities. He is a veteran emergency manager. He currently serves as Deputy Associate Administrator of FEMA's Insurance and Mitigation Administration and Senior Executive of the NFIP, the world's largest single peril insurance operation, providing over 1.3 trillion in flood coverage to over 5 million policyholders. David's expertise in emergency management and strategic risk communication stems from his substantial leadership roles in the private sector and local and state government. He was the former Nebraska mayor and senator and lieutenant governor. David, thank you so much for taking the time out of your busy schedule and joining us today. So everybody, please give David a warm South Carolina welcome.
Hey, Donna, thank you for that kind introduction and for inviting me to have a conversation with the South Carolina Realtors and others across the nation. It's great to be with you all today, and I hope everyone has been staying safe and healthy. I'm thankful for having a virtual space for today's conversation and look forward to the day we can all meet face to face once again. Let me start by saying that the impact of the National Association of Realtors' support of our mission to reduce disaster suffering cannot be understated. I'd like to thank you, South Carolina Realtors personally and sincerely for your role in NAR's endorsement of Risk Rating 2.0 Equity in Action. You've been a great partner over the years, and we're encouraged by your public show of support for this critical next step in closing the insurance gap in the country. We continue these efforts as a whole community, and we appreciate what our friends in South Carolina are willing to do to help us inform and educate on the merits of Risk Rating 2.0 Equity in Action. Andy Neal, the NFIP's Chief Actuary, is joining me today. And at the end of my presentation, we'll both be happy to take your questions. To begin my presentation, I'd like to provide some foundational context about this new cutting-edge approach that will provide equitable rates for each property's unique flood risk. While I suspect you are aware, however, it seems to be a surprise for some, rates already increase under the current NFIP rating methodology. Respectively, rates are going to increase for some policyholders under the new pricing methodology, and rates will also decrease for some policyholders. Later, I will speak more about what these changes look like across the nation, but right now, I want to highlight how those who will see increases under the new NFIP plan fundamentally differ from rate increases under the existing methodology. Currently, all NFIP policyholders have been subject to premium increases every year. In fact, from October of 2018 through January of 2021, premium increases have been in the range of 10% annually. These yearly increases are in line with the statutory limits required and would continue to occur year after year indefinitely for all policies if no changes were made. In contrast, under the new methodology, once a policy reaches its full risk rate, the increases stop. In fact, we project that approximately 25% of policies will reach their full risk rate within the first year. After 5 years, approximately 50% of all policies will be at their full risk rate, and approximately 90% of all policies are at their full risk rate at 10 years. It is important to understand that the NFIP's ability to identify individual policyholder risk has been improved with FEMA's increased technological and mapping capabilities. As a result of these advances, we now know that 2/3 of older homes, which are currently paying some of the highest rates in the NFIP, will see immediate premium decreases under the new methodology. With no change, current inequitable rates remain, and policyholders for many of these older homes will continue to pay more than they should. This is just one example of how the new plan sets the NFIP on the right course to create a more equitable, accurate, and individualized rating plan. To really appreciate what Risk Rating 2.0 Equity in Action means and how it's an improvement over current rating methodology, it's useful to consider where we're headed in comparison with where we are. Since the 1970s, rates have been primarily based on rather static measurements, emphasizing a property's elevation within a zone on a flood insurance rate map. This approach does not incorporate as many flooding variables as the new methodology. As such, Risk Rating 2.0 is not just a minor improvement, but a transformational leap forward. FEMA now has the capability and tools to address rating disparities by incorporating more flood risk variables like flood frequency, multiple flood types from river overflow, storm surge, coastal erosion, heavy rainfall, and distance to a water source, along with property characteristics such as elevation and the cost to rebuild, which I like to highlight. Since the new plan now takes into consideration the cost to rebuild, FEMA will equitably issue premiums across all policyholders based on the unique flood risk of their property. This has been an industry standard for years that the NFIP is now finally adopting. With Equity in Action, The NFIP is building on years of investment in flood hazard information by incorporating private sector data sets, catastrophe models, and evolving actuarial science. This includes using existing FEMA mapping data and NFIP policy and claims data, along with other federal government data from USGS, NOAA, and the U.S. Army Corps of Engineers. In addition, third-party commercially available structural and replacement cost data, along with CAT flood models, is incorporated. This approach is clearly a significant improvement. It allows us to set actuarially sound rates and communicate flood risk more comprehensively than ever before, enabling us to fulfill our obligation to clearly communicate flood risk. And although I don't need to inform you, risk is exactly what flood insurance pricing should be based on. By providing policyholders a clear and concise picture of their unique flood risk, we are also equipping them with the information necessary to make more informed decisions about taking mitigation actions. At FEMA, we believe mitigation coupled with insurance provides individuals with the essential tools they need to recover after disaster strikes. Before I get into further details, allow me to revisit the motivation behind our landmark efforts. It's the why behind all the hard work and commitment that's gone into making Risk Rating 2.0 a reality. FEMA has the statutory mandate to set actuarially sound rates and clearly communicate risk. Risk Rating 2.0 will address an inequity in the program that has built up over time and is not acceptable, an inequity that must be corrected. That is, policyholders with lower value homes are paying more than they should, and policyholders with higher value homes are paying less than they should. The new pricing plan enables FEMA to set rates that are fair and ensures rate increases and decreases are both equitable. In fact, we've learned that 2/3 of older pre-firm homes that have some of the highest rates in the NFIP today will see an immediate decrease in their cost of insurance. The new rating methodology has exposed these inequities, and we cannot turn a blind eye to our policyholders who have been unjustly subsidizing other policyholders. In addition, because our rating methodology hasn't been updated in more than 40 years, it is not fiscally sustainable in its present form to withstand the frequency and intensity of recent events and the storms we know will strike in the months and years ahead due to climate change. Our current system is just fundamentally not working for the program or our policyholders and must be revamped. It is a well-known fact that FEMA has been urged for many years from many quarters to improve its pricing methodology. While difficult, now is the time. Equity in action is transformational, but it is not changing every aspect of the NFIP. Several key features remain. We are upholding statutory requirements by limiting annual statutory premium increases so that the most rates do not climb by more than 18% per year. Also, the use of flood insurance rate maps for mandatory purchase and floodplain management continues. FEMA's flood map data informs the catastrophe models used in the development of the new rates, which is why flood mapping data will still be necessary and essential for communities as it will continue to inform floodplain management building requirements and the mandatory purchase requirement. We also maintain program features to simplify the transition to the new plan by continuing to offer premium discounts for pre-firm subsidized and newly mapped properties. And policyholders will still be able to transfer their discount to a new owner by assigning their flood insurance policy when property ownership changes. Finally, discounts for policyholders in communities who participate in the community rating system, CRS, will continue. CRS communities will continue to earn NFIP rate discounts of 5% to 45% for their policyholders based on the CRS classification. However, since Risk Rating 2.0 does not use flood zones to determine risk, the discount will be uniformly applied to all policies, regardless of whether the structure is inside or outside of the special flood hazard area, meaning the number of policies receiving the discount will increase. Over the next few minutes, I will walk you through the national analysis for all structures in the NFIP book of business, including single-family homes and non-single-family homes, levied and non-levied, for 5 million policyholders across all 50 states, the District of Columbia, and U.S. territories. Then I'll share how the NFIP is planning to roll out the new pricing plan. First, here's what the analysis of the data tells us. 23% of current policyholders will see immediate decreases in their premiums. On average, this will be $86 per month. That doesn't happen under the current rating structure, where rates go up every year for all policyholders, regardless of their level of risk. This should not be overlooked because it speaks to one of the tenets of equity in action, which is to reflect a property's unique flood risk accurately and fairly, and to price it accordingly. Before I move on to the next two categories of policyholders in the blue buckets, you'll recall that I shared that under the current pricing scheme, all policyholders have been seeing an average increase of $8 per month. Under the new pricing methodology, 66% of policyholders will see a $0 to $10 per month increase in their premiums. Overall, the impact on these policyholders is relatively neutral in year one. Another 7% of our policyholders will see on average a $10 to $20 a month increase, which is somewhat more than what they're paying under the current system. Finally, 4% of the NFIP policyholders will see a $20 or more increase in their monthly premiums. These policies cover high-value homes in high-risk areas. Currently, lower-value homes subsidize these properties, and in many cases are paying way more than their fair share. Equity in action eliminates this injustice. So for this group of policyholders, due to the statutory limits, it could be 10 to 15 years before they reach their true risk rate. Now I'd like to show at a high level what the changes mean when we break out single-family homes compared to the current rating system. In year one, at their next renewal, 82% of single-family homeowners will see 1, monthly decreases, or 2, increases of $5 or less with risk rating 2.0 compared to the current system. In year one, at their next renewal, 94% of single-family homeowners will see monthly decreases or increases of $10 or less with risk rating 2.0, essentially on par with the current pricing. And recall, right now, under the current rating system, policyholders do not receive premium discounts. Earlier, I explained that we've added a property's replacement cost value, or RCV, as a key factor in creating an equitable pricing methodology. Here's why that's significant. Under the current rating system, 45,000 policyholders will see increases of more than $100 a month. The single-family homeowners in this group have an average RCV of $399,643. Under risk rating 2.0, the number of policyholders drops to 3,200 who will see increases of more than $100 a month. The single-family homeowners in this group have an average RCV of $1,064,537. The numbers speak for themselves. Even policyholders paying the most today will see quite significant and immediate decreases when they transition to the new pricing plan. Broadly, over 1 million policyholders will see decreases. This includes over 600,000 single-family homes. At the extremes, 3,000 single-family policyholders pay premiums above $12,000 up to $45,000 per year. It may surprise you, as it did me, to learn that these policies are located across the nation, not just along the Gulf Coast. Today, policyholders paying the highest flood insurance premiums can be found in almost every state, except for Idaho, Utah, West Virginia, along with BC and the US Virgin Islands. Again, under the current rating system, these premiums could continue to increase year after year after year. The new plan has an upper bound that limits costs on the highest end of the spectrum. That means that no single-family home policy transitioning to the new methodology will see a premium of more than $12,125 under equity in action. The path forward is to facilitate implementation of the new pricing plan in a phased approach. Although COVID-19 has not directly affected our work with regards to the development of the NFIP's new rating methodology, we are conscious of the far-reaching impacts that this pandemic has had on the nation and existing policyholders. For phase one, any new policies beginning October 1st, 2021, they'll be subject to the new pricing methodology. Also beginning October 1st, existing policyholders will be able to take advantage of immediate decreases in their premiums. This is the fair thing to do. In phase two, renewals of the remaining existing flood insurance policies will be written to the new plan starting April 1st of 2022. That means this group of existing policyholders will have an additional 6 months to prepare for any rate adjustments. As you can imagine, designing a new rating methodology takes an enormous amount of resources. This didn't happen overnight. FEMA's investments span across time, people, and technology. We've invested thousands of hours into creating a cutting-edge rating system that is long overdue and years in the making. FEMA's investments span across the time and the people and the technology. The initial research began in 2016 with design and analysis beginning shortly after that in 2017. From 2018 and 19, FEMA conducted further analysis and laid the foundation for transitioning to the new rating system. In 2020, actuarial rates were finalized and system development began. To complete and integrate the methodology within existing programs and systems required a comprehensive cross-directorate effort throughout FEMA, including thousands of hours and over 20 experts. The methodology alone required full-time support from no less than 8 actuary and data experts, as well as the best contractor support available in the industry. These subject matter experts worked diligently to ensure alignment with federal regulations, systems, guidance, and policies. Once the methodology was completed, we then began the process of managing major business changes and the transition to new processes, new technology, and new ways of doing business. We relied on state-of-the-art technology and the best available data to create a modern-day rating system that builds and expands upon years of scientific developments, actuarial data, and environmental analysis. In 2017, a limited number of models were available that could produce average annualized loss estimates for fluvial, pluvial, and coastal flooding. While these models agreed on the general order of magnitude of flood losses for the nation, they could vary greatly by region and by location. As a result, a multi-model approach was adopted to determine flood risk, using a suite of models, much the same way that NOAA uses several models to determine potential hurricane tracks and magnitudes. The NFIP licensed 3 sets of commercial catastrophe models: AIR Worldwide, Cat Risk, and CoreLogic. In addition to the commercial flood models, FEMA developed 2 additional models based on government data and models. Not only has the new methodology taken thousands of staff hours to research, design, analyze, develop, and test, but FEMA has also spent many hours on outreach and engagement with a variety of industry and non-industry stakeholders, including leadership across FEMA, DHS, and other government agencies across the regions, within the insurance industry, in Congress, across professional and trade associations, and in the media. To date, FEMA has conducted more than 500 outreach and engagement activities around Risk Rating 2.0 equity in action. We have already seen a public show of support from many state insurance regulators, and we deeply appreciate it. We are thankful for the strong partnership we have with state insurance commissioners nationwide, and hope to see similar support from insurance companies, agents, and industry associations. Stakeholders are weighing in on the impact that equity in action will have to communities and policyholders. I'd like to reiterate my thanks to NAR, representing 1.4 million agents, for backing the new pricing methodology and acknowledging that Risk Rating 2.0 will help ensure that NFIP policyholders pay a rate proportionate to their property risk. And Pew fully supports our update, saying Risk Rating 2.0 will create a fair and more transparent program and encourage more mitigation. And we're seeing support from other experts appear in the press. In recent opinion piece in The Hill, Carolyn Kuski, the executive director at Wharton's Risk Management and Decision Process Center, stated that Risk Rating 2.0 is a critical step in preparing the NFIP for the realities of climate change. And just a couple weeks ago, the Wall Street Journal editorial board wrote Risk Rating 2.0 is a necessary move towards fairness and fiscal sustainability. This sampling of support reinforces that Risk Rating 2.0, equity in action, is a needed component of the transformation required to sustain the NFIP for decades to come. We encourage anyone with questions to visit our Equity in Action website at fema.gov/NFIP transformation for more information. There are many resources to explore, including an Equity in Action fact sheet, a video defining a property's unique flood risk, national rate analysis, state profiles, zip code level data, county level data, methodology data source document indicating how we developed the methodology, premium calculation worksheet examples. Let's turn our attention to affordability, which is an issue currently and will continue to be a concern with the implementation of the new pricing. We trust the affordability framework FEMA delivered to Congress in 2018 will continue to be most valuable as this policy discussion continues. The fiscal year 22 President's budget includes a legislative proposal that would establish a targeted means-tested assistance program for 1 to 4 family primary residences. This targeted assistance program would serve to offer the low and moderate income current and prospective NFIP policyholders a graduated risk premium discount. It's a real benefit. However, this, and it's important to note, FEMA would implement the program such that eligible low and moderate income policyholders see both the full risk price and the means tested assistance they receive, so they understand their true flood risk. Additionally, a successful program would provide additional flood mitigation assistance, grant resources to NFIP participating communities and policyholders who are eligible for the means tested assistance program. I look forward to collaborating with the administration's team and with Congress on ways to reduce barriers to purchasing flood insurance and pursuing mitigation options to achieve resilience. In closing, let me say Equity in Action will deliver a more equitable and risk-informed NFIP. This is not a check the box and move on effort. What we've developed is a foundational component in conjunction with other efforts that will transform the NFIP, which hasn't had a change of this magnitude in over 50 years. Thank you really appreciate your time and your attention. Donna, I'm ready to take your questions.
Good. Thank you, David. That was wonderful information. And thank you for sharing that with us. You know, David, guys, at the end of this, please just type in your questions at the bottom at the Q&A, and Austin Perez will make sure that they're communicated to David. David, you know, 9 years ago, I feel like it's when I started kindergarten, we had to deal with bigot waters. Congress passed that law. We saw in South Carolina premiums as high as $30,000 on properties that would only be $250,000. And we knew that was totally ridiculous, and we were totally alarmed, concerned, and worried about what would happen to homeowners. And if you took those numbers and broke it down, that would be assuming that that property would be completely washed away once every 4 to 8 years, which we know is just not true. So it didn't make sense to us as realtors. And as you can imagine, our members and their clients were concerned, to say the least. So South Carolina brought NAR down to see what was going on. And South Carolina provided many examples of excessive flood insurance rates. The information prompted NAR to create a brand new insurance committee at NAR, which I was honored to chair first. The committee met with FEMA. We hired independent actuaries to study the problem with NFIP rates and propose solutions. We even went to Congress with the information and succeeded in delaying the law for the next 5 to 10 years. Since then, David, you and I have, and many members have met and sat down and go over many discussions about bigot water rates and how we're going to fix the problems before they return. I, as well as the insurance committee, we're pleased to hear that FEMA first announced it would be updating its insurance rate to try and address the problems our members discovered many, many years ago. The committee recently met with you again and decided to support your solution to ensure that our clients don't ever see flood insurance rates that don't ever make sense again. You're calling it risk rating 2.0, and I'm calling it bigot waters fix. And I'm excited to be here with you today to help our members learn more about the solution and what you'll be rolling out next year. Now, for our first question, and I'm sure the members are really wanting to hear about this. After Bigot Waters Act, what happened? I'm not sure why any homeowner in the U.S. who had never seen $30,000 premiums before, all of a sudden had $30,000 premiums, and I don't think anyone could even anticipate that as a possibility. Can you talk just a little bit more about the current methodology and how it will be possible to see such high rate for moderately priced properties?
Well, you're right, Donna. However, I would like to first note that we do not have $30,000 flood insurance premiums for homeowners under risk rating 2.0. The maximum premium that someone will see is $12,125. The rates under the current pricing system do not always make sense. Unfortunately, the current methodology was 50 years old, and that's all we had to set prices in accordance with congressional mandates after BW 12, which is why, in part, after conducting a thorough review, FEMA decided to completely overhaul the current rating methodology. We needed to come up with a modern rating methodology that made sense for 21st century flooding issues. We had to go back to the drawing board. Risk rating 2.0 is equity in action is the result of thousands of hours of work in partnership with the private sector and many others, federal agencies, Congress, our partners, including realtors. But there should be, let's make no mistake, there should be no correlation between the new rating methodology and Bigot Waters 12.
Good. Thank you so much. I was stunned to learn that FEMA had not updated its current system in nearly half a century. I mean, it's as old as I am. Their old system was, and causing those $30,000 rates. Okay, now that we know the problem was an outdated rating system and Rate 2.0 proposes a modern fix of the problem, let's learn more about the solution. Tell us a little more about Rate 2.0 and how does this modern methodology avoid the problems with the current system?
But basically, the problem with the current NFIP rates is we only used one or two pieces of information about a particular property when we set our prices. Imagine if you were trying to help a client buy a property and all you could tell them is one or two things about the property before they could put down an offer. Imagine what your clients would say if all they knew about a property was its address or the number of floors or how many square feet the building footprint is. They probably wouldn't be your client for long. That's why we've updated the current system. Currently, we basically set prices on by a zone in which the property is located and the elevation of the lowest point of the structure relative to the 1% annual chance of 100-year or base flood elevation. And that's in the high risk flood zone. We only have one piece of information everywhere else when rating properties. But under risk rating 2.0, we will have 15 plus data points for each property. Most of these are calculated automatically and won't need to be answered by the insurance agent. For each home, we will know how far the building is from water, the elevation of the first floor, whether the building sits on a hill or in a valley, the types of flooding it is most vulnerable to, and most importantly, we'll know how much it costs to rebuild that property. Higher value properties tend to cost the program a lot more than lower value properties at claim time. So we will now use the industry standard of incorporating replacement cost values in the ratings. So we will be able to rate each and every property based on their unique characteristics and flood risk. That's what makes risk rating 2.0 equity in action fair and equitable.
Awesome, thank you. And that's logical to me. It makes tons of sense. As I mentioned in the intro, you and I have met many times in my capacity as former chair of the NAR's insurance committee over the years. We even signed a memorandum of agreement, Realtors and FEMA, to collaborate and educate consumers about the importance of flood insurance. I'm always reporting to our members how much work NAR and SCR, Association of Realtors, conduct on their behalf up there in Washington, and how their dues dollars are resulting in meaningful policy changes. I, for one, value the constructive working relationship that we have built with FEMA over the last 9 years. I'm just glad we can have a conversation where we're reporting progress on NFIP reforms. Can you please elaborate on the relationship between FEMA and the Realtor associations and how important we all are as members to your efforts on risk rating 2.0?
Well, vitally important. Where you can really help us in your role as industry professionals is by learning as much as you can about our new flood insurance rating system. As I mentioned earlier, the frequency and intensity of storms continues, and storms are hitting highly populated areas where there are only a handful of existing flood insurance policies. We need to continue all of these efforts as a whole community, and we appreciate anything folks are willing to do to help us inform and educate around risk rating 2.0 equity in action. We're all digging in and having to be more resilient in the face of climate change.
Right. You also mentioned that some flood insurance rates will be coming down under risk rating 2.0. My understanding is that 1 million properties will see their flood insurance rate decrease by as much as $1,000 per year as early as October 1. Do I have that right? And if I do, can you elaborate on what 2.0 rate will do to the rates here in South Carolina over the next year?
Yeah, I mean, you certainly have hit the target, on the bullseye. And South Carolina, roughly 200,000 policyholders will see about 26% will see immediate decreases, while in South Carolina, 65% will see an average of $0 to $10 a month increase, 6% the $10 to $20 per month increase, and 3% of policyholders over $20 a month. So overall, my math is right. That's 97% of current policyholders will either see decreases or increase by $20 or less per month. Again, the numbers, they speak for themselves. But as we know, under the current methodology, all NFIP policyholders have been subject to premium increases every year. And I can't, stress that enough. And so I'd recommend looking at, for folks to look at the South Carolina state profile on FEMA.gov, which includes impacts for state, county, and zip code. And that information is available for those that have joined us across the country for their state and communities also.
Right, thank you. So again, remind us when risk rating 2.0 starts. And you mentioned FEMA will begin implementing the changes on October 1st of this year, and more will occur in April of next year. Can you clarify that for all of our listeners?
Yes, thank you. The phase one is any new policy written October 1 of this year, that they'll be under the new methodology, but also beginning this October, those existing policyholders that we just got done talking about will also be able to take advantage of the immediate decreases in their premiums. Again, use the word fair and equitable a lot, but this is the right thing to do. Then 6 months later, April 1st of 2022, phase two will kick in, and the renewals of the remaining existing flood insurance policies will be written to the new plan. So 6 months after the risk rating starts, 6 months after, then those existing policyholders will, the rates will kick in for them, and they have that 6 months to prepare for any rate adjustments that might be coming their way.
Awesome. Now, I'm really excited about the new program. I'm more excited about the possibility of the rates and being more equitable to everybody, which I think is important. But as we know, when you roll out something new, there's always a few little problems and glitches. So in this statement, I'm gonna have several questions I want you to address if you could. So as those glitches arrive and you can't roll, how will you fix those problems if they're big or small? And how do you expect those problems to be addressed? Can you talk a little more about what we do when we come across those problems? How do we keep up with the collaboration and work together to ensure that if we are any major problems, we can bring them promptly to your attention and have them addressed? And also, we want to make sure that if you find you're in need of resources in the program as you roll it out, that we'll work with you and Congress to get those resources so that the program will be implemented smoothly and as quickly as possible with a minimum of any confusion and disruption. And how do we work together to continue that? I guess, David, that whole overall statement is when these things go south rather than north, or north rather than south, depending on how you want them to go, how do we address it and keep the consumer in the loop? And how do we communicate that with you to get those answers?
Yeah, certainly a lot to unpack there. And for the most part, the answer to many of those questions was yes. It's also, as you know, Austin and others within the association know how to get a hold of us, and we're in active conversation with you. We'll provide some additional information at the end of this, so folks know how to get in touch with us and also get their questions answered. But as you know, last month I made the case for equity in action in my testimony to the Senate Committee on Banking, Housing, and Urban Affairs, and advocated for a multi-year reauthorization and statutory authorities that would enable us to continue to transform the NFIP. I shared that equity in action is just one solution to a multi-pronged approach for reforming the NFIP. There's much more work to be done to ensure that we have a sustainable program built to withstand unpredictable weather system, one which is easy to understand, that's accountable to taxpayers, and is accessible for everybody, especially those with financial barriers to purchasing a policy. I mean, bluntly, right now, we're just simply not seeing the outcomes that we need to help close the insurance gap across the country, protect the natural and beneficial functions of the floodway, and promote judicious development, all to help make communities safer and more resilient. Our ability to exercise continuous improvement of the NFIP begins with the certainty associated with the multi-year reauthorization of the NFIP with meaningful reforms by September 30th of this year. In that hearing, I also shared our FEMA's 4 guiding principles that we believe will lead to this meaningful transformation. The first is increased flood insurance coverage, ensuring more Americans are covered by flood insurance by making insurance more affordable. Building climate resilience by transforming the communication of risk and providing tools to Americans to manage their flood risk. Third, reducing risk, losses, and disaster suffering by strengthening local floodplain management minimum standards and addressing extreme repetitive loss properties. And finally, and critically important, institute a sound and transparent financial framework that allows the NFIP to balance affordability and fiscal stability. Natural hazard events, particularly flooding, affect everyone. They don't recognize boundaries, so it's critical that our states, local governments, tribes, territories, along with our non-government partners and other mitigation stakeholders, work together to use our spheres of influence to reduce their vulnerabilities and create safer places to live, work, and do business.
Thank you so much. Now I have my one last question for me. I have to admit, I have a little bit of uneasiness because I lived through Bigot Waters testifying, working with you all, begging for extensions, seeing 14,000 homes not closing a day because of no flood insurance. I mean, it's a nightmare. So we heard about the rates for this next year, but what about 5 or 10 years from now, David? And let me ask you this, what if risk rate 2.0 becomes another Bigot Waters? What do we do? Help me with that. I know that's a question on everybody's mind. So,
well, first, thank you, Donna. This has been, I think, a vibrant and informative, hopefully informative session. We are going to remain committed to being transparent and being available to address as many questions as possible. We know that change is hard, and we want to do all that we can to help people feel at ease. I think I heard 3 questions. Let me break them down in a couple of responses.
sorry.
First, addressing the rates over the next 5 to 10 years. Under risk rating 2.0, your price is based on your risk. Yes, there will be small changes in premiums after you reach your full risk premium. For example, if the value of your home increases or there are actual changes in your underlying risk to your structure, but generally the premium you pay is based on your risk. Next, how can we work together? And what should realtors do if clients find future rates that don't make sense? I think we're doing that right now. We're engaged in meaningful dialogue. We're talking to each other. And as I said all along, we're open to your questions and are willing now and in the future to provide answers. Certainly, it may take some time, hopefully not too much time to get back to you. We ask for patience in some of those circumstances, but we're committed to being transparent, forthright, as we work together as a community of folks who are concerned about protecting lives and property from the perils of flooding. As I've mentioned, if you visit our website, wealth of comprehensive information at anyone's fingertips, whether it be the transformation site, whether that be floodsmart.gov. But let me wrap up this part by just saying, on behalf of the FEMA leadership and my team joining me today, we are extremely grateful for NAR's endorsement and the support of South Carolina Realtors. I understand, we understand that this is about building trust. Without it, moving forward will be very difficult. I'm committed to continuing to build upon the trusted relationship that we've already established with NAR. And I hope you are too.
You've been wonderful, and I can't thank you enough for your transparency, willingness to collaborate. It means everything, and you're right. It's just as realtors, we have to build trust with our clients. We're building that trust now with FEMA and you and your department, and we appreciate you. Thank you so much, David. Now I want to turn this over to NAR's Austin Perez. He is my right left hand, and I've made him bald-headed. And he's going to have some questions that he's going to present that comes from our realtors. And I want to thank everybody for watching today. Austin?
Yes, thank you very much. So again, I represent you, NER. I'm one of your policy analysts in Washington, D.C. And thank you very much, FEMA and Donna and President Wiles for the opportunity here for NER to participate in SCR's event. So I've been monitoring the chat, and I've been trying to find the questions that seem to be common. And so what I'm going to do is I'm going to summarize, try to combine some questions which I think were common, and present them to FEMA to decide how FEMA would like to answer, or who would like to answer from that. And we are very fortunate not just to have the Chief Executive of the NFIP, but also a panel of experts from FEMA here with us today in order to help answer your questions. So let me go through these questions. First, so there were a number of questions about what's changing, what's not changing under Rate 2.0. So first of all, I think just to clarify, so who is required to get flood insurance or not? Is that changing under Rate 2.0? Or what's the intersection between Rate 2.0 and the mandatory purchase of flood insurance requirement?
Yeah, I mean, that's an excellent question, Austin, that certainly comes up, and it's one that I can actually answer without going to my lifelines that are joining me here. So mandatory purchase doesn't change. The special flood hazard area doesn't change as a result of risk rating 2.0. So for those properties that are in the high risk area, special flood hazard area, as currently have a federally backed mortgage, they will continue to fall under the lender mandatory purchase requirement.
Great, thank you. So a second question, a couple of questions about what about the maximum amount of coverage? Will Rate 2.0 increase the amount of coverage available?
So right now, that's a statutory limit, and so it will stay the same at $250,000 for a residential structure and $500,000 for a commercial property. So again, risk rating doesn't impact that. It's certainly a topic that comes up when the reauthorization of the NFIP is discussed. And so there very well could be a change in the future, but it'll be a change that Congress makes.
Got it. So just make sure I'm clear on this. So essentially it affects the price that the NFIP charges for flood insurance. It doesn't affect who gets flood insurance. It doesn't affect how much. Those are the kinds of questions for Congress. All right, so which have to be answered by Congress in statute. All right. How quickly, questions about how quickly will insurance companies be able to quote? I assume people are looking for big rate decreases.
Mm-hmm. Yeah, that's it's around the corner. We're working very closely with our private insurance company partners that we call write your own companies and their vendors. And right around the corner now, it'll be August 1 of people will be able to understand how risk rating 2.0 will impact their premiums. So it's we're right there. I know that's going to be a real help for folks. And, it's clearly a couple months before the transition begins, and certainly a number of months before those that will see premium increases similar to what they do now next April. So there's quite a bit of time for folks to be able to understand how this is going to impact them, and then they can adjust their actions accordingly.
Great. So I have a number of questions about elevation certificates, which I know is a big piece of good news under the new system. Can you elaborate? Will elevation certificates be required? New ones be required? And what are the requirements on elevation certificates for rate 2.0?
Yeah, so I can answer this, but I want to bring Andy Neal, our chief actuary, into the discussion, and I'll let Andy answer that question. And then I think he actually has a couple of examples that are in the same category of discussion when we talk about elevation or elevation certificates. So Andy, why don't you take that, answer the elevation question, and then share a couple of examples that you have.
Sure. Thank you, David. And thank you, Austin, for having us today. The elevation certificate played a big role after Bigger Waters 12 that we talked about, where in order to find out when and if you had one of the older homes that we call pre-firm subsidized, and I won't completely unpack that box right now because it would take too long, but rates were increasing for those properties up to 25% per year since 2012. And an elevation certificate was a crucial way for us to understand the lowest elevation of your home and also what that base flood elevation is. Those two pieces of information David talked about that sometimes led to some unreasonable rates. Well, for many people, that elevation certificate eventually provided them an opportunity to have a lower rate under the current system. But even then, the elevation certificate is not necessarily inexpensive, depending on your home, where it's located, the complexity of your home. It could be anywhere from a few $100s to a few $1,000s to get an elevation certificate. Under Risk Rating 2.0, we're taking advantage of the big data world that we live in, where we have elevation data sets. We've partnered with CoreLogic to apply a first floor height tool that will let us estimate your first floor height, sometimes using remote sensing technologies in order to get an estimate of your first floor height. And you can use that estimate instead of having to get a costly and expensive elevation certificate. Now, if you have an elevation certificate already, you can bring that to bear in Risk Rating 2.0. If it provides a better answer than those estimates that we have native in the Risk Rating 2.0 system, then you can use that elevation certificate data. And we're also expanding some of the ability for elevation certificates. There's a section of the elevation certificate where you can self-measure your first floor height. And we're expanding the opportunity for people to use that as well. And so that gets to some of the questions Donna was asking. What do you do with an unreasonable rate? Well, there's two important pieces of information. Elevation is still important for flooding. You have our estimates based on big data that you can use. If you have an elevation certificate, that's available. There's the self-reporting ability of the first floor height of the elevation certificate. And then finally, making sure that the replacement cost value of your home makes sense is the last piece. And you work with your agent to make sure that that value makes sense. You get those dialed in. What we see is that a lot of people, their premiums are going to be very much in line with what they would expect. So no longer these really high premiums on low value homes that Donna talked about. By taking that value into account, a lot of those concerns fall away. We recently worked with someone in South Carolina on Hilton Head Island that is an interesting story that encapsulates the conversation that Donna talked about. It starts with Bigger Waters 12. They were paying about $1,000. It's a second home. They rent their property out and spend some time in it themselves, but it was a second home according to NFIP. Over the years, since Bigger Waters 12, until a year or two ago, the premium had increased to $4,000, almost $5,000. Person finally got an elevation certificate. They see their premium drop to about $2,800. Then under Risk Rating 2.0, they're thinking, do I need to rebuild this home? This is someone, like I said, Hilton Head Island. It's a slab on grade, older structure, but not very expensive structure. Their premium will drop again when Risk Rating 2.0 comes into effect. They are in the special flood hazard area. It'll drop to mid 2000s. If they carry out their reconstruction project, their home value is going to go up, but then Hilton Head Island has some great floodplain management where they're asking for some extra feet of elevation. Their premium would drop again after they rebuild their home, make it more expensive, but build it a little bit safer. So for that particular situation, it's a good news story upon a good news story. I'll also say my little brother He signed a release for us to be able to use him at times to talk about. He lives in Charleston on Logan Street downtown. His home has a fairly high replacement cost value, but he is on one of the higher parts of Charleston there. And he's going to see a premium decrease. He already did the same thing. He was a pre-firm structure, got an elevation certificate, lowered his premium sum to about $1,300. He's actually going to see his premium come down a couple $100 under risk rating 2.0. So a lot of people are thinking, this means that everybody's premiums are going to go up a lot higher. And that's not nearly the truth. It's combination of risk and value drives this, but the premiums will be very reasonable.
Thanks, Andy.
Well, just to make sure, that's very helpful. Just to cement the point, because I get this concern question from members, probably the second most of the time, and it sort of boils down to, okay, I'm paying a flood insurance premium, I'm paying federal taxes for flood maps. We all know that those maps vary in quality, accuracy, and coverage across the nation. So why do I now have to go out and get an elevation certificate and pay an engineer $500 to $1,000 in order to show what we all know, which is my property doesn't belong in the flood zone? So that's kind of the gist of the narrative that we hear very often. So just if I make sure, I want to make sure I'm hearing this. So under rate 2.0, there is no longer a requirement for an elevation certificate. No one will have to actually go out and spend that $500 to $1,000 in order to get priced quoted at an insurance rate. Just want to make sure if it helps with the rating, you can provide it, but you are not required, because you already have access to, FEMA already has access to high quality data sets from the federal government in order to automatically plug that information when a quote is given. Do I have that all?
Yes, that is absolutely right. One of the big things that was actually happening when people would get that they would appeal through a process, the LOMA process, where they would say, hey, my ground is actually higher than this base flood elevation. And what was happening there is the ground elevation data sets 5 or 10 years ago weren't terribly precise. And so a surveyor would go in and they'd say, I see your ground actually peaks above that base flood elevation. And so you get a special certificate saying that you're out as shown on the map. But then under risk rating 2.0, we're able to take advantage of what they call Lidar data, which is very precise. We have it for almost all of our policyholders. So we already know a really good estimation of your ground elevation and where your property sits relative to that ground. So you do not need an elevation certificate. If you have one and it provides a better answer than what that Lidar answer is, we will lower your premium, but we don't penalize you for having an elevation certificate already, and it could only work to your advantage, and you don't need to get one.
Got it. And also specific to this question, I just want to make sure it's clear. So you don't need an elevation certificate. You're getting charged a property specific risk. I think a lot of the bigger waters rates, the concerns that we saw in a lot of the questions, I think sort of mirror this, had to do with an insurance agent plugging bad information into picking the wrong number on the rate table, selecting whether it's pre-firm or post-firm. It was insurance agents providing information that wasn't exactly correct to FEMA, and then FEMA would provide back insurance to submit the rate process, and you would see a rate that was out of line with sort of the value and the risk of the property. So under rate 2.0, are you still charging different rates or asking different questions based upon whether it's an A zone or an X zone, or I saw a Cobra zone question in the chat? So like, how does your prices vary from zone to zone to zone under rate 2.0, or does it?
Well, there's no zone anymore with risk rating 2.0 to start with. Okay, so we now have a graduated risk methodology. So what zone you're in relative to how your insurance will be priced, that goes away. But what you're talking about, Austin, is another benefit that of where we're going, in that it's going to simplify the process of applying for a flood insurance policy for both the policyholder, the customer, the consumer, and the insurance agent. You're absolutely right. I mean, currently we're still in the pencil and paper, look in a manual that's, you know, as thick as an old-fashioned phone book, and you know, try to calculate what the correct premium would be based upon a 2-page application that asked a ton of questions. That all goes away now. We've developed a rating engine where the insurance agent will input, I'll just say around 10, answer 10 questions. There's a lot going on behind that in the rating engine that is not seen by anyone, that calculates a premium that then will be consistent from agent to agent, unlike now where you can go to 5 different agents and very likely may have 3 different quotes just based on how they're calculating and using the rate manual, which was cumbersome and complex. So we're simplifying the process. We're hopeful that it will actually incentivize agents that have stayed away from the program because of its complexity to take another look at the program and get involved and help close the insurance gap for their customers and, you know, your customers. Also by doing so, bring more policyholders into the program, which is vitally important because after every major flood event that we have, not anywhere near enough property owners have the flood insurance protection they need to get on the road to recovery. So it's a very important part of what we're doing. It's a little bit, you know, on the, you know, not necessarily talking about the rates themselves, but the process is going to be so much improved for everybody involved. It's going to be a much better customer experience.
Thank you for that. Well, and also not to put too fine a point on it, we've certainly gotten questions from homeowners under the current system where they've got a subsidized rate. That's what it says on their policy, is it's a subsidized rate. But we go to FEMA through the Office of Flood Insurance Advocate, and we find out that the property owner should have provided an elevation certificate so that they could get off the escalator. So instead of seeing 25% increases, they could have provided an elevation certificate and gotten off that escalator years ago. And in some cases, they get reimbursed significant amounts of money because of confusion about providing an elevation certificate, or in one case, an insurance agent forgot to provide the elevation certificate. And so there's just a lot of confusion where a lot of older subsidized properties are being overcharged significantly under the current system because it requires additional steps and correct decisions by a whole bunch of different parties. But under Rate 2.0, that all goes away. It goes from a 2-page application process under the current system down to 5 to 10 questions. And a lot of those 10 questions are optional. And also, so a number of questions about, so is everyone going to see a rate increase up to that $12,000? Could you clarify that $12,000 that you mentioned as an absolute maximum cap? Is everyone going to go to that $12,000 number, or could you clarify a little bit?
Oh, heaven's sakes, no. Again, you know, we estimate 25% of policies are going to reach their full risk rate in the first year. So, I mean, the 12, and again, I'm going to toss this to Andy. I mean, the 12,125, from my perspective, eliminates any uncertainty about the scary type of you know, changes that are underway and being happened. It just takes that off the table. Nobody can say, you know, under risk rating 2.0, a single family residence, their home's going to, you know, their insurance is going to cost $25,000. That's just factually not right. So, but Andy, why don't you talk about the 12,125 limit in the importance and the actuarial basis for establishing that upper limit?
Yeah, thank you, David. So very few people will see that 12,125. It takes a combination of both a high home value and extraordinarily high risk to reach that. So that's kind of the upper end. But keep in mind, under the current rating system, what we call risk rating 1.0, sometimes shorthand, the lower end is kind of the preferred risk policy for $250,000 of insurance and $100,000 of replacement cost value. It's about $500 now, depending on whether you've got a basement or not. It goes all the way up to the very highest premiums that we see are up to $45,000, in excess of $45,000 under the current system. And like David said, in most states, there are people well above the $12,000 cap that we see under risk rating 2.0. So what happened? We were able to do a lot of additional analysis of risk. Under the old system, all I knew is your base flood elevation and how high that lowest floor was. And in situations where people were 5, 10, 15, even 20 feet below base flood elevation, that was a rare situation, but it led to very high premiums. But we were blind to the total picture of risk because all we knew was that base flood elevation and where they were. And when we looked at loss history for those structures, they were flooding frequently and sometimes with very high claims. So, but when we look at risk rating 2.0, taking so many more variables into account, breaking your risk into kind of an inland flood risk and a coastal risk, being able to look at how close you are to different flooding sources. And when we say close, that means both a horizontal distance as well as an elevation. What we find is that when we segment the population using that more modern based actuarial approach, we see that even in the higher risk cases where values are high and the risk looks high, we don't need to charge as high an aggregate premium for them. And so we have certain limits on a lot of the factors that are out there. The replacement cost value, one thing we see is that once you get up to a very expensive home, about 95% of NFIP homes are $600,000 or less. Once we look at those properties that are $600,000 or more, a $2 million home ceases to make as big a difference price-wise as like $1 million home. Yes, it's got twice the value, but usually their claim sizes, partly due to the $250,000 cap, remain about the same. So as price goes up and up and up for those very few people, those 5% of NFIP policies that are over that $600,000 point, we don't necessarily see that home value matters as much. It matters up to $600,000. So they're paying a lot for their value, but we can temper that and not continue to take home value into account. And that's one of the main drivers of that 12,000 cap is kind of looking at RCV and saying, once you get up above $600,000, we know you're high. So you're kind of at the upper end of the range for that actuarial factor, but I don't need to keep going. That was one of the disadvantages to the old system. We didn't have ways to look and say how high is too high, but we've built that into this system to make sure that we're back checking against actual historical data, making sure that this high isn't too high. It's one of the tenets of setting rates. We want to make sure that rates are adequate, but we also want to make sure they're not excessive. And risk rating 2.0, by using replacement cost value and better estimates of risk, lets us achieve that end of it's a mantra for flood insurance rating at the regulated level all around our country.
Thank you for that. I know we're out of time. I just want to thank FEMA. After Bigger Waters Act, I couldn't get someone just on the 1-800 number for FEMA, but our insurance committee, which I have the privilege to be staff executive to, I think we've met with you 6 times in the last year just on Rate 2.0, this insurance committee of NER members. I see Laura Crowther. There are a number of people listening today who have been a part of or are currently part of the insurance committee and have met with you personally on this. The amount of time that you spent, the amount of data, the amount of information that you provided, the patience in answering all of our questions, we thank you very much, FEMA. It's a very different relationship that we very much value and appreciate. So I just wanted to recognize that for a moment. So that I know we're going to get other questions answered, and we're going to have an email to get those additional. So every one of our members has a question. NER is also going to have a similar town hall on this later this summer that we're working with FEMA on. So it will not be the last chance to get your questions answered. But we just want to thank you again, FEMA and David Maurstad, Andy, for just all the help that you've given us in information. And so with that, let me turn it back over.
Thank you, Austin.
Thank you, Austin. And I want to again thank David, Andy, Kelly, Ben, and all the other FEMA staff that helped put this on today. This was real informative and really a great, info session of finding out more about Risk Rating 2.0. I'd also like to thank Donna Smith for joining us. And it's always great to have her questioning, and she knows this inside and out, which is great to have. And also thanks to Austin Perez with NAR for helping coordinate the webinar. If anyone has any questions that weren't answered throughout this webinar, please feel free to send an email to FEMA. We're going to get some emails out, a follow-up email with contact information listed in it. Also, you can always call the SCR legal hotline at 803-772-5206 or send an email to information@screaltors.org. There are multiple resources available also on FEMA.gov. And I want to thank everybody for joining us again. I want everybody to have a great day and stay safe out there. Thank you.